And what I'm going to do is kind of go over the basics on how to figure out if it's a good idea for you to refinance right now based on what your current rate is. Good afternoon, everyone. Ken Angst, Hope Properties NV, the Angst Real Estate Team. Welcome back to our channel. If you like our content, please hit the subscribe button below and leave any comments, or if you have any suggestions for future episodes on what you want to talk about in real estate in Nevada, let me know below and we'll do our best to do an episode on that. So I'm getting a lot of calls about people wanting to refinance. And while I don't personally do mortgages, what I'm trying to do is educate people on a high level to make sure that they're getting a good deal when they're talking to lenders. Now, we have two preferred lenders, and what I'm going to do is kind of go over the basics on how to figure out if it's a good idea for you to refinance right now based on what your current rate is. And just keep in mind that this is a very simple example. Once you start dealing with issues where you don't have 20% loan to value in the property, and you have PMI and mortgage insurance, the example gets a lot tougher. But what I want to do today is educate you and make sure that when you're talking to a lender that you don't know, make sure that you know how to calculate it to make sure it makes sense for you financially speaking to go ahead with refinancing your house, because that's the hot thing right now with rates in the 2.5 to 3 range, kind of depending on your situation. So the example I kind of wrote up here is we're assuming a home value of $300,000 and you have a mortgage balance of $200,000. So that's the case right now, and this assumes that you have more than 20% equity in the home. So keep in mind, I will have one of our preferred lenders on next week to kind of talk about what happens when you don't have 20% and kind of do that calculation to still make sure it makes sense. So cost to refi, and these are just numbers I picked out of the air. So it's going to vary on lender to lender, and these are just numbers that I chose for this example. So don't quote me on these. These are not set in stones. These are just an example, and you can use this video to kind of calculate if it makes sense. So cost to refinance is about $3,000. Your current interest rate is 4% on a 30-year fixed, whenever you got that. And keep in mind that, so this is your payment for principal and interest. Now keep in mind that if you have a mortgage, you have an escrow account. Also in that account will be prices or amounts every month for property taxes and your annual homeowner's insurance. But when you're doing this calculation, those calculations are going to stay the same. So you only want to compare your principal and interest payment. So typically on any mortgage statement, you'll be able to find your current payment just on principal and interest. So in this example, for a 4% 30-year fix at $200,000, it's $955. And the example I'm using is 2.75 because we've locked some of our clients in at that rate at 2.75, 30-year fixed. And the payment, principal and interest only, is $816. So what you do is you take your original payment, which was $995, minus your new payment, which your new payment would be with the new mortgage, and that was $816, and you get the delta. So the delta is about $140. So what we'd like to see, if it makes sense financially, is we like to see a payback period of less than 15 months. I mean, if you can get less than a year, great. But how you calculate this is you take your refinance cost, $3,000, divided by how much you're saving on a monthly basis, and you divide it. In this case, it would take a payback period of 21 months. So that's above the threshold that I personally recommend to our clients. Like I said, 12 to 15 months really makes sense. And typically you want to see a delta, even to consider this, is you want to see a delta of the interest rates from what you currently have from what you want, at least 1.25, 1.5 before it actually kind of makes sense. So keep in mind the payback period, and I want to reiterate this one last time before we let everyone go, is to make sure that it's less than 15 months. 12 months is preferable. So if you're seeing a 21-month payback period, I would not do it, because generally speaking, most people in the United States on average move every 5 to 7 years. So if you're getting out there past 15 months, you're not going to ever really see the cost, and all the money is going right to the lenders. And keep in mind that when you reset your mortgage, and if you've been on your mortgage for like 10 years and refinance it, you start back over at 30. And most of the upfront payment on mortgages is all interest. And then as you get towards the end, it pays down the principal on your balance. So if you guys have any other questions, let me know. We'll be in the office all weekend, 775-525-0309. And we'll make this episode 1. And then what we'll do next week is we'll have one of our preferred lenders come in and talk about what's going on in mortgages, because it's a hot topic. Great rates, but I want to buyer beware. Take advantage of them if they make sense financially. And you guys can always call me and we can give advice, but just keep in mind that I'm not a mortgage broker. So you guys have a good weekend, and we'll talk to you soon. Thanks.